Thank you very much. Hi, everybody. Thank you for taking the time to listen to the Nedgroup Investments Flexible Income Fund quarterly report back. I'll jump immediately into the performance of the fund. So the performance of the fund gross of fees has been 9.8% over the last year. And I think it's more important to focus on the returns for the last year as opposed to the last quarter, which is a very short-term performance. But you can see the quarter was also decent, returning 1.8%. So where have the returns come from over the last year? It's come from a number of buckets in the portfolio, really sticking true to that diversified alpha style that we invest the portfolio in. If you look at the South African floating rate bonds, that contributed 2.8% of performance. So that is really a nice, strong, stable underpin, which is earning money market plus about 1.8%. And that is a nice low risk contributor to returns. We've also seen positive contribution come from the nominal bonds. Those would be predominantly SAGBs, South African government bonds. We have actually seen a yield sell-off in those bonds, particularly in September, but our positioning on the curve, which has been on the shorter end of the curve, has actually bode well for the portfolio, and we've still managed to generate a positive return there. And then we've also seen positive returns being contributed from the linkers and from the cash portion, and also from the offshore portion. Offshore bonds themselves have not contributed positively. That is more really to do with the rand depreciation. We have continued to see yields in global markets sell off, but I will touch on that shortly. So if we look at the global backdrop, we've called this presentation Here We Go Again, because it really is becoming a bit of a repetitive story where we see global developed market central banks talk a lot more hawkishly. We see CPI or inflation stay a lot stickier. And all of a sudden, the market has to recalibrate its expectation for rates. So the September FOMC was particularly newsworthy. It wasn't so much for rate expectations for this year. It still looks like the FOMC members are expecting one more 25-point hike this year, potentially. But I think what really threw the markets is if you look at their expectation for the next 2 years. So the plot that I'm showing you there is the average expectation of the FOMC members that vote for the Fed rate hikes. So if you look next year, in the previous meeting, it looked like they were going to cut a lot quicker over the next 2 years, whereas what they showed us in the September meeting is actually, it looks like the cutting cycle is going to be a lot slower and a lot shallower. So the market again has had to redigest this higher for longer narrative that is coming through from central banks. So not only did we hear this coming out of the Fed, but we also heard this coming out of the Bank of England as well as the ECB. So this higher for longer narrative is really become ingrained in the developed market central bank space. So the big question is why? Is it purely that inflation is staying higher for longer? It is an inflation story, and it is coming out slightly above expectations. It is looking a bit stickier than expected, but I think what is really surprising the Fed is just how strong the economic data is coming out. You can see this particularly when it comes to the job market. So what I'm showing you here is the non-farm payrolls data. And essentially what this is showing is how many jobs every month are being added in the US. The long run average is about 150,000 per month. So when you think of the US economy contracting, you would think that it needs to start running below that long-term average. And we are still not seeing that. We are seeing the numbers coming out. I mean, the last print was still over 330,000. So given where rates are, I mean, this extreme move, and you can see this in the next slide, just how this extreme steep upward moves in yield have been, but it is still not really coming through from an economic point of view. So the question is why? This might be that the soft landing narrative is correct, that the US economy is just so strong that there's still a lot of support coming from the fiscal side, that there won't really be this hard-hitting recession in the US. Alternatively, it could just be that monetary policy is lagging and that there might still be a hard-hitting effect to come. We don't have a crystal ball, and we certainly don't invest for one event versus the other. But it will certainly be interesting to see how this plays out. Just looking at the US yield curve, however, it does feel quite toppish at this point in time. There does look like, at the very least, it is in fair value to cheap territory. And you can see that relative to history, we haven't seen yields at these levels since about 2007, 2008. So it really has been an extreme fixed income market over the last 2-3 years, and it's kind of been precipitated again over the last few months. So the global backdrop remains highly volatile. Let's look at the local rate side. Interestingly, if you look at the emerging market space, you're actually starting to see some emerging market central banks cut. So we've seen that coming out of Brazil, coming out of Chile, coming out of Poland, but our central bank is probably sticking more to the developed market central bank rhetoric, where the last MPC was certainly more hawkish than what a lot of the market was expecting. You can see the FRA curve, so that is the market's expectations of where the repo rate will go, or where JIBAR will go. You can see that pre-MPC, the market thought the cycle was quite toppish, and you can see post-MPC, the market then again had to start thinking that maybe there were additional hikes to come. So why are we acting differently to other emerging market central banks? There are a number of reasons. Firstly, we did not hike as aggressively as some of the other emerging market central banks. So our interest rate differential relative to the US has not been as elevated. But contrary to what a lot of other EMs experienced, we also didn't see this very big inflation problem. Our inflation has pretty much, been within the target band for some time now, and we think that remains the case. But what has changed is that there is some upward pressure on core goods expected. And of course, the price of oil has thrown out a lot of what the previous CPI expectations were, because there is a lot of upward pressure there as well. So although we think we remain within the target band, we don't think we get to the midpoint of the target band this year, probably likely only later next year. The other reason for our more hawkish interest rate expectations is coming from the fiscal side. So there is a lot of pressure from the fiscus. We are expecting quite a bad MTBPS. We know that the deficit is going to be a lot worse than what was expected. And that does have an impact on monetary policy, where there is this realization from the MPC that the neutral real rate might have to be higher than what was previously expected. So there are numerous factors that are affecting this kind of more hawkish stance from the MPC. Now, just a bit more detail on the MTBPS. I've mentioned that we are expecting that it will be a poor update. What exactly that means in numbers is that the revenue shortfall will be somewhere between about 40 and 60 billion, and that is largely coming from a smaller corporate income tax revenue. Naturally as a result of commodity prices coming down, but then we are also seeing greater upward pressure from the expenditure side. So overall, we think that the fiscal gap for the 23-24 financial year will be somewhere in the range between 70 and 100 billion, which means that the fiscal deficit will probably be just north of 1% higher. And naturally, that has implications for the outer years. So we will see much higher fiscal deficits being projected in the next MTBPS. So what does this do for the debt dynamics of South Africa? Naturally, that debt to GDP trajectory is going to be a lot higher. Instead of peaking now under 75% over the medium term, it'll probably be closer to 80%. The real number to watch going forward is what this is doing to our debt servicing costs. That's the really expensive part of this, and that's probably somewhere now around 20% of revenue. So that really does start to put a lot of pressure on the budget. The big question that I think everyone should be looking out for is, what does this mean in terms of issuance? Because I think this is the biggest short-term implication of the MTBPS. they likely won't announce any kind of issuance if it is not, desperately needed right now. They tend to more announce issuance changes in their actual budgets in February. And I think the dynamic will also very much rely on what happens to the R197 maturity, which is happening in December. If we see big switches of that, then there likely won't be that much pressure for them to increase issuance as aggressively. But I think that the base case is that if not now, in February, bond issuance will have to go up. There was some talk around VAT hikes. That seems very unlikely to happen in an election year, but that would be a positive if that went through, as it would kind of plug some of this fiscal gap that we are starting to see grow quite extensively over the next few years. So just from bond valuations, if we look at, what do we think about bond valuations, especially in the context that we think that the supply will likely go up. We do believe that a lot of this is probably in the price. The market is very much expecting issuance to go up. If you do a thumbsuck 10-year bond valuation, you can take the US 10-year, which is at 2.5. You can add your long-term SA inflation expectations, which would be somewhere between 5 and 5.5%. You've got to add a small inflation risk premium. And if you back solve, we're trying to see what is the market implying that the country risk premium for South Africa is. And that is somewhere between the range of 3.6 and 4.1%, depending which inflation expectation you use. It's probably on the fair side, but I think where you can argue that bonds are cheap is that you're probably seeing value in the US real rate. I think there is value at the US 10-year real, the 2.5. And also, we are still using higher inflation expectations than the midpoint of the target range. So you can argue that bonds, especially in this 10-year period, are cheap, maybe fair value, but where we really do see value is in the extreme kind of steepness of the curve. So your long end bonds are looking particularly cheap, whereas your shorter end bonds are probably looking more fair. But then again, there is more risk on the higher end bonds. They run a lot higher duration. And just from a scenario analysis point of view, in a fund like flexible income, where we place a lot of emphasis on capital preservation, we have a lot more comfort on the shorter end of the bonds. So we are predominantly invested in the R2030. So this has got about a 6-year term left, and I just want to present our thinking to you in a bit of a scenario matrix. And we've labeled this slide that a lot has to go wrong for us to be wrong. And why do I say that? So those bonds are currently trading at a yield of about 10.8. So if we buy a bond at 10.8 and it stays there for the next 6 years until it matures, our annualized total return is 11.1% per annum. Okay, so you're getting inflation easily plus 6. Let's put a bit of a negative context on this, and let's put a 3-year investment horizon. So let's say bond issuance goes up a lot more than the market is thinking. There's a lot more volatility, and it's a terrible 3-year period. And we see yields spike by an extra 3%, which is a very extreme scenario. Over the next 3 years, my total return in this bond will still be 8.6% per annum. That is still inflation plus 3, easily. So in the absence of a complete meltdown where South Africa sees much higher inflation, a lot quicker, a lot more consistently, we really believe that this is a fantastic instrument to hold in the context of a flexible income fund. And to our point, a lot has to go wrong for us to be wrong in this kind of instrument. So although we think long-end bonds are cheaper, the kind of more conservative nature of this bond is where our preference is at this point in time. And I think you can see that around the scenario analysis. So what does the portfolio look like at this point in time? The yield on the portfolio is 10%. So, there is a good chance that that our return over the next year will be double digits, especially since we think that, a lot of asset classes are still also trading on the cheap side. So you've got a strong yield, and I think you've got a good potential for capital gains. The fund duration is sitting in total at 1.4 years. That's made up of 0.85 in nominal bonds, 0.25 years in linkers, and we are 0.3 years in offshore bonds. So from a construction point of view, you've got about 36% of the fund generating JIBAR plus 1.8, so that's a really strong yield underpin, and a lot of our duration obviously translating into our allocation into linkers, into nominal bonds, and into offshore bonds. We do have a small allocation to SA property. There are certain counters there where on a sustainable dividend yield is starting to look a bit more attractive, but I think the kind of the economic conditions for this asset class are still very difficult, so it is something that we would tend to remain a bit more conservative on. And then just from an FX exposure, although we have quite a significant portion of the fund in dollar bonds or in offshore instruments, we do hedge a lot of that rand or that dollar exposure back into rand. So our effective currency exposure is currently at about 3.6%. So we do think that the prospects for this fund over the next year are very attractive, and we think it's a very good time for fixed income funds in the market at the moment. And thank you very much.